I came across a neat little article about 7 bad investing habits. And I'm just going to do these real quick, but I think they really do make a lot of sense. The first, this comes from a book I've never heard of, but it's called Heads I Win, Tails I Win, written by Spencer Jacob with a K, Jakab. 7 habits, and he talks about the 7 bad investment habits. Number 1, get in on that hot new deal. Okay, somebody tells you about a hot stock tip out there, okay, or there's a hot IPO that you need to get into and stuff like that. I've been hearing I listen to some satellite radio, and they're running these ads on satellite radio for some IPO that's 10 cents a share, okay. It's like just throwing your money away. But they make it sound like it's going to go to $100 a share right away. So don't chase hot deals, just whether it's an IPO or whatever. Okay, here's one that really I find fascinating. This next item on his list, and this comes up all the time: combining your money and your morals. All right, think about this. This is really interesting. Sinful stocks. Those are tobacco, alcohol, gambling, go on and on and on. Have bested the S&P 500 index both over the long term and between 2000 and 2015. Investors who are morally opposed to such companies, and many people are, and that's why there is this, it's not a new type of investing, it's called socially responsible investing. You invest in companies that do good in theory, okay? And what he says, those investors who are morally opposed to such companies can consider donating some of their investment profits to charities such as the American Lung Association or whatever. But it's an interesting thought to do that. I talk to a lot of people who are very much socially responsible investors, and there are a lot of great mutual funds that are structured for socially responsible investors. They don't own those kinds of companies that they find to be morally challenged. Number 3, this is, again, bad investing habits. Buy what's fashionable. The market constantly votes on which companies are most likely or least likely to succeed and adjust valuations accordingly. I heard somebody on one of the, I think it was on CNBC the other morning, talking about, he was watching and looking at all the stocks that are hitting new lows. And there aren't very many of them, but he's looking at stocks that are hitting new 52-week lows or all-time lows. He's looking there for buying opportunities. That's probably the worst place to look for buying opportunities. You don't want to buy stocks that are going down, okay? Especially in a market like this. Other people have suggested, you're looking for stocks to own, take a look at stocks that are hitting new highs, because they're going up for some reason. There's a reason why they have been consistently going up over time and probably will continue to go. Don't try to bottom fish. There's an old expression on Wall Street, never try to catch a falling knife. And that's what happens when you try to buy stocks that are at on the new low list. Reaching for yield. This is really dangerous in these times for a number of reasons. Again, as I mentioned, interest rates are low. You're going to stay low for a long time, and that makes a lot of people, especially those on fixed incomes, puts them in a very, very difficult position. They want more money to come in from their investments, but in order to do that, they have to take some risk. And so it can be a really frightening experience for them. Plus, it leaves them oh so vulnerable for investment fraud. It really does. I look at the pages of the Securities and Exchange Commission and the Financial Industry Regulatory Authority all the time. These are 2 watchdog groups, and they always have reports of whatever the latest scam or fraud or ripoff is. And most of them are targeted toward seniors, okay? They asked Willie Sutton once, he was the famous bank robber. He said, "Willie, why do you rob banks?" He said, "Well, that's where the money is," okay? Today, the money is in the hands of people over the age of 65. 75% of the wealth in this country is in the hands of people over the age of 65, okay? And, it does you no good to run an investment scam targeted toward a 23-year-old single guy living with his parents, okay? And doesn't have any money, okay? It's not gonna work out real well for you. So what they do is they find ways to ingratiate you. They come up with, well, it's the Bernie Madoff thing. They promise you safe, secured returns of 10, 12% or whatever, and they just convince you that the money is safe when obviously it's not. Remember, we live in a 1% world. Anything above that is going to carry with it a certain amount of risk. That includes stocks, bonds, any other thing that they promise you generates those kinds of returns isn't as safe as other types of investments. Let me just, another one real quick, trade frequently. It's been proved that people who try to time the stock market lose money. It's just very, very hard to do. The stock market it gives you ample opportunity to have risk. You don't need to magnify that risk by trying to time in and out of the stock market. You find that very few people when we were back in the right around the dot-com bubble back in 2000 and that, there were people that were quitting their jobs to day trade stocks, and it was found out that about 11% of them made money. Okay, which means 90% of them didn't make money. So don't go chasing stuff like that. So those are just a couple of interesting things I thought were kind of important in there.